Hi everyone, welcome back to the course. Let us continue with module number 15, that is pre-market and post-market analysis. Professional traders start their work 90 minutes before the opening bell. Here is exactly what to check and why. SGX Nifty at 6:30 a.m. onwards. The Singapore Nifty futures are the best real-time proxy for Indian market direction before 9:15 a.m. When SGX Nifty is plus 150, expect Nifty to open approximately 150 points higher. Monitor this continuously from 8 a.m. Dow Jones and S&P 500 overnight close. India follows US markets with a 60 to 80% correlation in short-term moves. Dow down 1% typically means Nifty gaps down 0.5 to 0.8%. But always check if the US move was company specific. One stock crash does not affect India or macro Fed rates employment data, which does. Crude oil. India imports 85% of its crude oil. Rising crude equals inflation. Current account deficit, rupee weakness, and pressure on aviation, paint, tire, and OMC stocks. Above $90 per barrel is concerning for India's macro. Opening range breakout. Let the first 15 minutes complete. Note the range, high and low of the first candle. If price breaks above the 15-minute high with volume above average, buy. Stop below the 15-minute low. Target 2 times the opening range. If price breaks below the low, short. Same logic inverted. ORB with confirmation from SGX Nifty direction and FII data has a historical win rate of 65 to 70%. Let us move to the next module, that is event-based trading. Event-based trading. India has a rich calendar of market-moving events. Approach each systematically, not reactively. RBI monetary policy. BI monthly. Most important domestic event. Rate cuts bullish for BFSI, real estate, NBFCs. Rate hikes bearish same sectors. Strengthen INR. The day before, IV rises on Nifty options. Strategy: sell ATM straddle if IV is at 52-week highs. Collect the IV crush post announcement or buy straddle 5 days before if IV is at 52-week lows. Benefit from IV expansion. Union budget. February 1 every year. Single biggest annual market event can create 5 to 10% single day moves in specific sectors. Strategy: buy Nifty straddle 2 weeks before when IV is still building. Exit the next trading day as IV collapses 30 to 50%. Sector positioning. Identify budget themes from leaks, analyst reports, and government hints. Position in those sectors 2 weeks before. Quarterly earnings. Large cap stocks. TCS, HDFC Bank, and Reliance can gap 5 to 8% on results. Never hold options through earnings without a specific thesis. IV crush post earnings on individual stocks is often 40 to 60%. If you must trade earnings, use spreads. Buy ATM straddle plus sell 5% OTM straddle. To define your risk while participating in the move. Post-event positioning. The safest event trade. After the event, IV has crashed. Options are now cheap. Buy ATM options and trade the post-event trend direction. Lower IV means better risk reward on option buying. This is often the best option buying opportunity of the entire month, and it is completely ignored by most traders who chase the pre-event action. Next module is module number 17, that is advanced position sizing. Advanced position sizing, we covered the 2% rule in the course 4. Now let me give you the mathematical framework for optional position sizing, the Kelly criterion. Kelly formula. Kelly percentage equals W minus the quantity 1 minus W divided by R, where W equals your historical win rate from your trading journal and R equals the ratio of average win to average loss. Example, after 100 live trades, your win rate is 55%. Average win is 10,000 rupees. Average loss is 5,000 rupees. R equals 2, Kelly equals 0.55 minus 0.45 divided by 2 equals 0.55 minus 0.225 equals 0.325 or 32.5% of capital per trade. This is fully Kelly. In practice, never use full Kelly. Full Kelly maximizes long-term geometrical growth mathematically but creates extreme variance. Use half Kelly. In this example, 16.25 of capital per trade. Still aggressive for most traders. Most professionals use 25 to 50% of calculated Kelly. The most important rule, Kelly is a ceiling, not a target. Never exceed your Kelly percentage. Above Kelly, ruin becomes mathematically inevitable over enough trades. You can trade less than Kelly. That is conservative and safe. But above Kelly, even a winning strategy will eventually destroy your capital. Requirement. You need at least 100 live trades to calculate accurate Kelly parameters. Until then, use the conservative 2% risk rule from course 4. Kelly is for systems with proven track records, not new strategies. Scaling in and out. Position management after entry separates great traders from good ones. Two concepts, pyramiding and scaling out. Pyramiding is adding to winners. Only add to a position when it is already profitable and your original thesis is intact. Start with 50% of your intended position. Add 30% when the first target is hit. Add the final 20% on the next breakout. This way, your average cost is always below current price. Never add to losing positions, ever. Scaling out. Book profits in tranches. Never exit 100% at once. Book 33% at the first target. This ensures you cannot lose on the trade. Book another 33% at the second target. Let the final 33% run with a trailing stop. This psychology, locking in partial profits early, makes you a much more disciplined trader because you have already secured gains. Confidence-based sizing. Not all setups are equal. High conviction setup. All 7 checklists items confirmed. Trade full Kelly size, medium conviction, 5 to 6 items. Trade half size, low conviction, below 5. Skip or trade quarter size. Matching size to conviction is one of the most important skills in professional trading. Now let us move forward to our final module, that is pulling everything together into a sustainable competitive edge in module number 18, that is building your own edge. We have covered 18 modules of institutional tools and frameworks. Now comes the most important question. How do you turn this knowledge into a consistent personal trading edge? The 6 steps edge building process. An edge is a repeatable statistical advantage, a set of conditions where you win more than you lose, with enough reward to justify the risk. Without a defined edge, you are not trading. You are gambling with extra steps. Step number 1. Choose your market. Pick one instrument, Nifty, weekly options, Bank Nifty, or specific sector ETF. One instrument mastered completely is worth 10 instruments dabbled in superficially. Step number 2. Build a testable hypothesis. I believe that VWAP bounce trades on Nifty after 10 a.m. with volume dry up at VWAP and RSI between 45 and 55. Produce positive risk adjusted returns. This specific statement can be tested. Step number 3. Backtest. Apply your hypothesis to the last 12 months of historical data. Calculate win rate, average win, average loss, and maximum consecutive losses. Sharpe ratio. Is the edge statistically significant? Does it work in different market conditions, different years? Step number 4. Paper trade to validate. Backtesting uses historical data and hindsight. Test execution. Paper trading tests execution in real time with real emotions, real slippage, real hesitation. Paper trade for 3 months minimum. Compared to backtest results, significant divergence means the system is harder to execute in practice than in theory. You need to simplify the rules. Step number 5. Deploy with minimum viable capital. 50,000 rupees. One Nifty lot. Every trade logged, deviations from rules documented. After 50 live trades, review is the edge performing as in paper trading. Step number 6. Scale only what works. If the system is profitable for 6 consecutive months on minimum capital, double the size. Then double again after another 6 months. Never scale a losing or unproven system. Position sizing amplifies the edge if you have one and amplifies destruction if you do not. The complete institutional framework summary. Let me show you how all 18 modules connect into one cohesive system. First is micro layer, checked weekly. FIIDII flow trend, sector rotation analysis, global skews, DXY US yields crude. This tells you the market's broad direction and which sector to be in. Next is structural layer, checked daily. Market profile levels, POC, VAH, VAL, OI analysis, call wall, put wall, PCR, max pain for Thursday. This gives you the key price levels and expected range for the day or week. Next is tactical layer, which is checked on 4-hour and daily charts. SMC structure: CHOCH, BOS, order blocks. Wyckoff phase identification. Anchored VWAP, supply and demand zones. This gives you specific entry zones and trade direction. Next is execution layer, which is checked 15 minutes to 1 hour charts. VWAP bound setup, opening range breakout, candlestick confirmation, volume confirmation. This is the precise entry trigger and stop placement. Next is options layer. When applicable, Greeks analysis, PCR and IV rank, gamma squeeze watch, strategy selection, buy or sell which strike. This optimizes how you express your directional view through derivatives. Next is risk layer, always active. Kelly based position sizing 2% maximum risk rule. Scaling rules, daily loss limit, journal. This ensures you survive to trade another day regardless of what the market does. The key insight: you do not use all layers simultaneously on every trade. You use the right tools for each decision layer. Weekly macro guides, daily structure guides, hourly execution. Top down always. Let us move forward to 90-day implementation plan. You have completed 18 modules of advanced institutional trading content. Now implementation. Week 1 to 2. Set up your tools. Subscribe to Opstra or Sensible for Max Payne and OI analysis. Set up TradingView with VWAP, Anchored VWAP, and Market Profile. Create your morning checklist spreadsheet with the 7-day data points from Module 13. Fill it every morning for 14 days without trading. Weeks 3 to 4. Paper trade your primary setup only. Choose one setup. I recommend VWAP bounce or Max Payne gravitational trade for beginners to this framework. Paper trade it on Nifty for 4 weeks. Log every trade including your 7-point morning data at time of entry. Week 5 to 8. Add OI based levels to your analysis. Before each paper trade, confirm that your entry direction aligns with the call wall and put wall levels. Check if PCR supports your directional bias. This second layer of confirmation significantly improves win rate. Weeks 9 to 10. Review your paper trading journal. What is your win rate? Average win-loss ratio? Which setups worked and which failed? This is where you refine your personal system, not before. Weeks 11 to 12. If paper trading shows consistent profit if paper trading shows consistent profitability across at least 20 trades, start live with 50,000 rupees of capital. One lot, maximum one trade per day. Apply every rule from your system religiously. Months 3 and beyond. After 50 live trades, calculate KLI. Scale systematically. Never use the scaling process. Never rush the scaling process. The traders who rush to scale before their system is proven are the ones who blow up. Final words: the mindset of a professional traders. I want to leave you with the most important things I have learned from 18 years in capital markets. First, the market does not owe you money. It rewards preparation, discipline, and patience, and punishes overconfidence, emotions, and impatience. Every successful trader I know has gone through a period of significant losses before finding their edge. It is not a sign of failure. It is the curriculum. Second, your worst enemy is not the market. It is not HFT algos. It is not FIIS. It is your own psychology. The fear that makes you hold losing trades hoping they recover, and the greed that makes you hold winning trades until they reverse. Systematic rules exist precisely to manage this psychology. Third, the best traders I have met are not the most sophisticated or the most technically advanced. They are the most consistent. They follow their systems when it is uncomfortable. They take losses cleanly and move on. They do not chase missed opportunities. They do not revenge trade. They show up every day, do their process, and let compounding do the work. Finally, you now have more knowledge about institutional trading than 95% of retail traders in India. This course, combined with Course 3 and Course 4, gives you a complete institutional grade analytical framework. What you do with it now is entirely up to you. At Fintamin, our mission is to democratize financial education for every working professional in India. This course is our most advanced offering, and I hope it has been worth every rupee and every hour you invested in it. If you have any questions, we are at FintaminCare. If you have questions, we are at fintamincare@gmail.com or WhatsApp us on 9860 148848. I look forward to hearing about your progress. Thank you for choosing Fintamin Institutional Trading Framework course. Now go implement it. Health report. Also, please visit www.fintamin.in for your free financial health report. Thank you for joining us. Have a nice day.